Do this now. I'm your host, Steve Van Metre, and thanks for joining me today. Credit card companies are about to announce a major change, and what you can do to stop it. Let's head over to CNBC, where we picked today's story up with this rebooted headline. The Fed's latest rate hike means credit card holders can expect higher bills this spring and summer, and now this fall, winter, and into next year. Individual banks and finance institutions use the federal funds rate as a starting point to set their own prime rate and the interest rate passed on to their most creditworthy customers. However, credit card holders' interest rates are well above the prime rate. In fact, most credit card issuers add several percentage points to the prime rate to make their cards' interest rates. The latest 0.75% hike that we just saw last month by the Fed will likely cause a 0.75% increase in your credit card interest rate. This means that if your interest rate is 15.25%, it's probably going to 16%. But according to Schultz, it could take consumers 1 to 2 business cycles to see this increase reflected in their credit card APRs. That means starting this spring, summer, now fall, and into winter, card holders can expect higher credit card bills if they carry a balance month to month. And so that's what we're looking at right now as we head into the holiday season. We have credit card balances back at record highs, and consumers are about to get a raise, not in what their income is, but in what their annual percentage rate is, meaning their minimum payment is going up. And if Fed continues to hike after the holiday season into early next year, they're going to see their balances get bigger and bigger as these Fed rate hikes translate into bigger interest payments and higher minimum payments. But is the Fed likely to stop? Well, doesn't look like it. The Fed won't pivot from this rate hikes until the end of 2023 as inflation is persistent and the economy isn't slowing as expected, according to JP Morgan. That's contrary to the outlook of many experts in the market who have warned this year that the Fed may be forced to pivot in order to avoid causing recession. Despite inflation clocking in above expectations in September, Wharton professor Jeremy Siegel noted that inflation was likely being overstated in the official statistics, and some sectors of the economy, like housing, have been deteriorating in response to rising interest rates. But a pivot is unlikely in the near term, given the underlying resilience of the U.S. economy. And that's the risk we face here, is that the Fed has a look back that it uses to determine policy. We know the CPI is a lagging index, but at some point it's going to head much lower, but not likely fast enough to get them to pause, meaning we're on track for a November hike. We still have the potential of a December hike coming after that, but at some point soon they'll pause. But for those with big credit card balances, it doesn't mean that's going to stop them. It means that you're going to pay more in the months to come. And how much more? Well, let's take a look, because it doesn't look good. Credit card debt returns to levels before COVID-19 pandemic. Total card balances in the U.S. hit a whopping $916 billion in September, nearly identical to their December 2019 levels, according to Equifax. Balances are up 9% in January and about 23% higher than their pandemic low in April 2021. Card balances fell sharply in the early months of the pandemic after Americans, out of work and stuck at home, cut back on spending, but quickly ramped up spending when stimulus checks continued to come in. When the economy reopened and people went back to work, credit card issuers launched a big push to get people to borrow again, and many loosened underwriting standards, making it easier for people with lower credit scores to get cards. Now Americans are spending and borrowing despite fears that a recession is on the horizon. Missed payments on credit cards while rising remain below pre-pandemic levels. And so even though consumers are still holding up pretty well, we're starting to see early signs that they're starting to get caught into this inflationary cycle where their wages aren't keeping up with prices. And that means they're making that hard choice to stop making payments on their credit cards. But it's not that bad yet. But if things continue, it's going to spiral out of control. Still, rising credit card balances could be an early sign of financial pain, and usually they are. Consumers are still paying a higher share of their balances than they were before COVID-19 hit, according to card issuers, but that figure at some lenders is starting to decline. The rising cost of food, gasoline, and housing, meanwhile, has strained household budgets, forcing some Americans to use their credit cards to make ends meet. And we know that that is actually happening because we can look into the data. We can actually see that when there's periods where the consumer price index moves higher, that we see credit card balances go with that. To that, let's take a look at this chart from the St. Louis Federal Reserve, but we're going to tack on not just credit cards, but other revolving plans, notably now at record high. Here you see in blue, but notably we have the CPI in red. Notice a trend higher in the CPI. What happens? Credit card usage goes up until the recession finally hits and consumers change their pace. How about here? You notice inflation trending down, slowing down, credit card balances holding steady here, inflation rising. We note balances head higher. And so you can see it's very clear that when consumers can't keep up with inflation, they first turn to their plastic, and then when that doesn't work, then they start cutting back. Trillions of dollars in rainy day funds that Americans built up during the pandemic are dwindling. The personal savings rate as a share of disposable personal income fell to 3.3% in the third quarter, one of the lowest readings going back to the late 1940s, and down 26.4% in the second quarter of 2020, and that is severe. Here you can see the personal savings rate at a very, very low level. And what this often gets misinterpreted as is that savings are at a very low level. What it is, it's a percentage of disposable income. So what happens is consumers will get caught up with inflation and they will have their disposable income shrink, and they'll dip into their actual savings to get by. But there's a certain point that every consumer goes through when they see that their paychecks aren't going any further and their savings are dwindling down, that they'll start to cut their spending, and that usually starts to happen when the savings rate gets really low. And we can continue with that line of thread as we note that real or inflation-adjusted disposable personal income remains negative. So we know, in fact, that wages are not keeping up with inflation, forcing consumers to use their credit cards and dip into their savings to maintain their standard of living, which won't continue much longer as it will be eventually forced to cut spending as inflation continues to go higher. Yet some card issuers have begun pulling back on lending to consumers they deem to be most vulnerable in a recession. Nearly all set aside money to cover loan losses in a potential recession, and this is a risk for consumers who are going to, some of them who are going to find themselves hitting a spending wall as their credit card companies say no more, and then that's when the forced cutbacks really begin. At Citigroup, Bank of America general purchase credit card spending fell slightly from the second to third quarter while balances increased, evidence that people who are carrying debt from month to month are contributing to rising loan balances, and that again is a sign of economic stress and inflation on households. Despite rising interest rates, issuers have ramped up offers for cards that don't charge interest on purchases or balance transfers for a period. That could be contributing to increase in balances because borrowers have less incentive to pay down their debt during the promotional period. And that's the one key thing that consumers can do right now is go out and transfer those balances while they still can get credit before the banks start cutting people off, which they tend to do when the economy gets worse. Discover Financial began tightening underwriting in the third quarter for new card approvals for segments that will be most volatile in a downturn, such as people who are on the lower end of prime, and there's the risk we see that eventually they will raise those lending standards and cut more and more people off. But for the moment, wages continue to rise, but that's not going to last. As U.S. wages rose rapidly in the third quarter, keeping pressure on inflation. The Employment Cost Index, a measure of worker wages and benefits, rose 5% in the third quarter from the same period a year earlier, the Labor Department said on Friday. The gains marked a slight cooling from the second quarter when the index rose at the fastest annual pace in records dating to 2001, allowing consumers to keep up with their debt. But the compensation reports don't do much to ease concerns about persistent price pressures in the services sector of the economy, which could keep the Fed raising interest rates slightly higher in 2023 than they anticipated at prior meetings. The data will keep the heat on the Fed, and that means credit card balances are going to go higher as minimum payments are going to go higher as interest rates are going to go higher. And at some point, what that will mean is we're also likely to see, as the economy slows, the unemployment rate start to rise, and that's when things get really dicey. And here we can see the 4-week moving average initial claims remains at very low levels at some point, and I like to believe this will happen after the holiday seasons or toward the end of December, when all of a sudden consumers pull back on their spending and all of a sudden employers start to cut back. And one thing we'll note is this could bring back people into the labor force, as we note the labor force participation rate, or the percentage of the workforce that is participating, remains very low, around the 61%. What could happen here is we could see a flood of workers coming back into the workforce in order to pay off their debt, and that would put downward pressure on wages at a time when consumers need their wages to go up to make sure they make their debt payments. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.